The current time is Sunday, January 25th, 2026, which means the market is currently closed for the weekend. The last recorded trading session for Vertical Aerospace Ltd, ticker symbol EVTL on the New York Stock Exchange, concluded on Friday, January 23rd, 2026 at 4 p.m. EST. At that time, the stock was trading at $5.60 USD, representing a decline of 0.15 or 2.61% for the day. While a 2.5% drop on a Friday might look like a standard cooling-off period for a volatile small-cap stock, the underlying mechanics of this movement tell a much more interesting story than a simple red candle on a chart. Most retail traders looking at their Robinhood app or browsing investing sites for a quick tip might see this as a sign of weakness, but if you look at the timing of this price action, it coincides almost perfectly with the public debut of their new commercial aircraft, the Valo, at the Classic Car Club in Manhattan. This creates a fascinating tension between the physical reality of a finished, high-specification aircraft being touched and seen by investors in New York and a stock price that seems to be dragging its feet. The immediate expectation for many in the online investment community was that the U.S. tour and the presence of the Valo in New York City would trigger a massive buying spree, similar to the hype cycles we often see with Tesla stock during a new product unveiling. However, the reality is that the market is currently digesting the hard numbers of the certification timeline rather than just the aesthetic appeal of the carbon fiber fuselage. While the crowds were gathering on Pier 76 to see the four-seat cabin and the panoramic windows, institutional traders using Interactive Brokers trading tools were likely more focused on the fact that the company just completed its third full-scale prototype. This is the detail that the broader market is missing. By moving from a single prototype to a fleet of 3 aircraft, Vertical Aerospace has effectively tripled its data gathering capacity. In the world of aerospace, data is the only thing that matters to regulators. This fleet expansion is a quiet way of de-risking the entire program because it provides a layer of redundancy that simply didn't exist 3 months ago. If one aircraft needs a battery swap or a software patch, the testing program no longer grinds to a halt. There's a common belief among those into self-investing that Vertical is just another speculative EVTL play that might run out of runway before it ever carries a paying passenger. This perspective is understandable given the capital-intensive nature of flight, but it misses the contrarian angle that is actually driving recent institutional interest. Unlike many of its competitors who are trying to build the aircraft, the charging infrastructure, and the ride-sharing app all at once, Vertical is operating as a pure-play manufacturer. They are working with the established giants like American Airlines and Japan Airlines, who already have the passengers and the operational expertise. When you check your Fidelity mobile app or use the SoFi trading platform to look at the order book, you aren't looking at potential interest, you're looking at pre-orders from some of the most established names in aviation. This focus on being an OEM rather than a full-service taxi operator allows them to keep their head down on engineering. The recent trading volume on Friday reached about 1.1 million shares, which is slightly below the 30-day average. This suggests that the 2.61% dip wasn't a mass exodus of smart capital, but rather a lack of aggressive bidding while the market waits for the results of the upcoming piloted transition flight. For anyone using Interactive Brokers fees as a metric for high-frequency moves, the volatility in EVTL has been manageable compared to the wild swings we see in something like Nvidia stock or even some of the more speculative crypto assets on the Robinhood app. The institutional activity has been particularly telling lately. We have seen significant positions held by Mudrick Capital Management and even entries from firms like Citadel and Millennium Management. These are not firms that chase hype in the traditional sense. They are firms that trade on technical milestones and regulatory certainty. When these big players move, they don't do it through a simple individual brokerage account. They use complex execution strategies that often hide their true intent until the 13F filings come out. If you're managing your own intelligent portfolio or utilizing Schwab Intelligent Portfolios for your broader asset allocation, you have to look at Vertical's recent regulatory win with the UK Civil Aviation Authority. The CAA recently granted them the power to approve their own flight conditions. This is a massive administrative advantage that allows the company to bypass the usual bureaucratic wait times between tests. It means they can fly, adjust, and fly again on their own schedule. This is the kind of detail that doesn't usually make the front page of Fidelity Investments or SoFi Active Investing news feeds, but it's the primary reason why the company can now move twice as fast as it did in 2025. This regulatory trust is a moat in itself. It's hard to build that kind of relationship with a top-tier regulator, and it's something that even well-funded competitors are struggling to replicate in other jurisdictions. Looking back at the older reports, it's clear that Vertical had some growing pains in late 2024 and 2025, specifically with a minor test incident that pushed back their transition flight. The market punished them for it, which is why the stock is sitting at $5.60 today, rather than the double digits it saw in its early days. But the business model remains robust. They have designed the Valo to fly up to 100 miles at 150 miles per hour, which is the sweet spot for urban transit. Imagine taking a 5-minute flight from JFK to Manhattan instead of a 2-hour crawl through traffic. This isn't just a luxury for the ultra-wealthy. The math behind the 6-seat expansion of the Valo suggests that seat prices could eventually compete with premium rideshare services. This is why Fidelity wealth management professionals and those looking for investment help are starting to take a second look at the sector. It's not just about the flying car, it's about the massive inefficiency of ground transport that these aircraft are designed to solve. For those of you tracking this closely in your Robinhood Investments or your Interactive Brokers account, I want to hear from you. Comment below how many shares of Vertical Aerospace you are currently holding, or if you are waiting for the piloted transition flight before you buy in. Hearing the sentiment from the community is often as valuable as the technical data because it shows where the retail wall is sitting. The macroeconomic pressure is the final piece of this puzzle. With interest rates showing signs of stabilization in early 2026, the cost of capital for these long-term aerospace projects is finally becoming predictable. This is a far cry from the environment of 2 years ago, where every rate hike felt like a direct hit to the valuation of pre-revenue tech. Now, investors are looking for growth that is substantiated by physical assets and clear paths to revenue. Vertical has a $5 billion order book. Even if only a fraction of those orders are realized, the current market cap of around $550 million looks increasingly disconnected from the potential. It's a classic case of expectation versus reality. The expectation is that this is a moonshot that might fail. The reality is that they have 3 full-scale aircraft, a world-class engineering team, and a regulator that has given them the keys to their own testing schedule. When you compare this to the momentum we see in Apple stock or the relentless climb of Nvidia stock, it's easy to feel like you're missing out on the action by holding a quiet aerospace play. But investing sites often forget that the biggest gains aren't made in the crowded trades. They are made in the quiet periods before the public realizes a major milestone has been hit. The upcoming piloted transition flight in the first half of 2026 is that milestone. If that aircraft moves from a hover to wing-borne flight successfully with a pilot on board, the narrative changes instantly. The speculative tag gets replaced with pre-production, and that usually leads to a significant re-rating of the stock. Whether you use Fidelity IRAs for long-term holds or you're day trading on the Robinhood trading platform, the strategy here is about patience and recognizing the shift from a single prototype startup to a multi-aircraft engineering powerhouse. In terms of risks, we can't ignore the cash burn. Developing aircraft is expensive. While the asset-light OEM model helps, they still need to maintain a strong balance sheet to reach that 2028 certification goal. This is why investors often look at the Fidelity ETFs or Fidelity mutual funds that have exposure to the industrial sector to see if the big money is moving in. So far, the institutional support has remained steady, which provides a bit of a floor for the price, but any further delays in the testing schedule could test the patience of the market. The current support level at around $5.50 seems to be holding, and the technical buy signals from recent rectangle formations suggest that the downside might be limited in the short term, barring a major macro shock. To summarize the core of the situation, Vertical Aerospace is currently trading at a discount because the market is judging it by its past delays rather than its current operational speed. The expectation is that 2026 will be another year of wait and see, but the reality of the 3-aircraft fleet and the New York City route planning suggests they are closer to commercial reality than most believe. They have moved from being a company that talks about the future to a company that is showing the hardware on the streets of Manhattan. The contrast between the $5.60 price tag and the $5 billion order book is one of the most stark examples of a valuation